Most of us are familiar with the VIX, the CBOE volatility index that has become the benchmark for measuring fear in the market. But what most of us don't know is that the VIX has a sibling, the Skew index. In this video, I'm going to talk about the Skew index, how its levels today compare with the past, and if it's telling us to prepare for another incoming market crash in September of 2020. Born out of the same S&P 500 index, the VIX and the Skew both track the implied volatility of SPX options. Implied volatility can be thought of as a measure of uncertainty. The higher the uncertainty in prices, the higher the implied volatility. The better known VIX tracks the implied volatility of at-the-money options. When the market is in a state of fear, the VIX rises. The critical thing to note here though is that the VIX rises in tandem with the market index falling. So the VIX is reactionary. Like ants that scatter only after you thump on the table, the VIX jumps when the S&P index gets attacked. The Skew, on the other hand, behaves quite differently from the VIX. The Skew index tracks the implied volatility of out-of-the-money options. These out-of-the-money options represent tail risk, or the risk of larger than expected moves. We can think of these as buying insurance against an alien invasion. It's very unlikely to happen, but if it does, it could be catastrophic. Because the out-of-the-money options can be far away from the current underlying price, the Skew will not react with the same intensity as the VIX during a sell-off. You see, the Skew does not measure the intensity of fear at any given moment. Instead, the Skew measures anxiety. When traders start to get anxious that a big movement in the market might be occurring soon, they start buying these cheap out-of-the-money options as insurance. This activity increases the implied volatility of these out-of-the-money options, and hence Skew starts to rise. The Skew typically ranges between 100 and 150. The higher the Skew, the higher the tail risk in the market. For the past couple of months since the COVID-19 market crash in March, the Skew had been hovering between 115 to 130, which is around normal levels. But the past 2 weeks had seen a dramatic spike in the Skew. From 126 in mid-June, the Skew hit 148 and could continue higher. Should we be worried? Is another big crash coming? To find out, let's see what happened the last time Skew was this high. The last time the Skew went above 145 was in mid-December of 2019. Back then, the market was rosy, hitting new record highs a few consecutive days in a row. Giving warnings about an impending crash back then would brand us as Chicken Little. Well, fast forward 3 months later and the market had its biggest tumble since 2008. To be fair, nobody could have known that a global pandemic was brewing and that life as we know it was about to change forever. Perhaps the Skew spiking a couple of months before the crash was just a coincidence. Let's go back further in time, to August and September of 2018. The Skew was once again above 145. When the Skew had subsided back below 130, the market had not started to fall. It was only in December, 3 months after the Skew subsided, then the market took a big tumble. Now of course we can't cherry pick data to suit our argument. There were also several times in the past 5 years where the Skew rose above 145, but the market did not sell off. Traders had hatched for the rainy day, that never came. So what can we say about today's Skew prices? Is a big sell-off coming? Well, the Skew seems to price in an increased chance of that happening. Based on historical patterns, a sell-off may occur 2 to 3 months after the Skew subsides. There is no telling how long the Skew will stay elevated above 145, but the fact that it's breached 145 is an indication that traders are starting to get a little anxious. Combine this with the other historical pattern of inverted yield curves causing 2-year-long sell-offs before we hit bottom. It doesn't bode well for the markets in the second half of 2020. The COVID-19 crash took place in February, but we have already witnessed the market bounce back barely 4 months later. If this is a dead cat bounce, or a dead cat ate rubber balls on its last meal, already news reports are hinting that the economy is in a terrible place and the market is propped up only by monetary policy. Perhaps it is because of reports like this that traders are starting to hedge for another big crash, building the Skew higher and higher. I wouldn't be surprised if the markets took another big tumble, falling to prices below the March low. When that happens, the investors who were looking at the VIX as a leading indicator would be sorely disappointed. The VIX would surge concurrently with down moves, but rarely prior to. It would be traders and investors like you who now know about the Skew index that would have seen this coming months away.